Well, let's get some perspective now from one of the most accurate forecasters of America's labour market. He's Rob Carnell, a former senior international economist at Commonwealth Australia Bank, currently chief international economist at ING Wholesale Banking. Welcome. Thanks for coming to talk to us. So, I've just introduced you as being extremely accurate.
Yeah,
what is your forecast?
That's a big build-up, isn't it? Well, it sounds like we're at the very bottom of the pile right now. Your colleague mentioned the range going down to minus 250. That's where we're sitting today. Has to be said, we've only just made that change in the run-up to the payrolls figure itself. You get a lot of data. ADP survey is one of the ones that we look at in particular. And that was pretty weak earlier in the week. So on the basis of that, we moved from about minus 120. We thought, well, let's go for it. Let's go for minus 250, so we'll see what happens.
So pretty pessimistic. The problem really is that jobs aren't being created, is that right?
Very much so. I mean, there is a bit of hiring activity going on in the US, but I think that the real issue is that the activity that we've seen in the US, the jobs that have been created, my guess is that a lot of them have been a response to the fiscal stimulus that's been running through the US and to some extent in Europe as well. You've seen activity going on. Now all these stimulus plans are beginning to come off, and we've seen for the last month, all the data's been dreadful. Yesterday was a great day if you're a bear on the economy, because just everything that came out was awful. And just leads you to suspect that whilst double dip may be pushing it a bit, that may be a bit excessive, that we're certainly looking for a slower period of growth in the second half of this year, and you wouldn't be extrapolating this year's growth forecast through to next. Whatever we get this year, let's call it 3%, start there and take a bit off rather than adding something on.
All right. I mean, the point being really that the stimulus artificially inflated the economy rather than actually really inflating it, which was the idea.
The patient was on an iron lung. That's been switched off and it's gasping quite badly right now.
So looking forward then to the US economy, you see actually next year as being a little bit worse than this year in terms of growth?
Not only a combination of the fiscal stimulus measures that are going to be taken off, but also things like the plans to regulate the financial sector and the lack of any real improvement in credit growth. I mean, a number of the leading indicators as well pointing downwards at the moment. People are talking a lot about this ECRI indicator at the moment, which is supposed to be a good indicator of recessions. I'm not sure whether I'd put all my faith in a leading indicator, but let's not ignore it. It's giving us some important signals.
And when we move across to look at Europe, we also have similar problems of unemployment and lack of job creation. Can you draw too many parallels between Europe and the US right now?
I think you can increasingly draw parallels. One of the ones with the US is this lack of of job creation at the moment, and that's been a European feature for a very long time. People talk about Eurosclerosis, this idea that Europe can't sort of readily shed its long-term unemployed. And the US has an increasingly large proportion of its unemployed who are long-term, and this is one of those things that policy struggles to affect. If you've been out of work for more than 12 months, you're not really going to benefit that much if the central bank just chops interest rates. That helps some businesses, but your chance of getting a job are already diminished because you've been out of the labour market so long. So the usual policy measures don't seem to work very easily, and the US is suffering in this respect like Europe used to.
We're seeing these austerity measures coming in across Europe. One of the first countries to introduce the austerity measures was Ireland, and actually they've just seen an increase in their GDP as little green shoots. Should we be optimistic about that?
I'd take any bit of good news right now.
Me too.
There's not much of it around, so yeah, I'd be optimistic about that. I mean, Ireland does stand out a little bit. It was it wasn't kicking and screaming into austerity plans. Yes, it had a mess, had a boom which went bust, and very quickly the Irish decided, right, this is what we need to do. We've got massive debt. We need to do something about it. They set up the bad bank, the NUMA scheme, to start improving the situation. And now we're beginning to see some positive things coming out of this. So slightly different situation to perhaps some of the southern European states who really were a bit reluctant into this. Hopefully similar sort of things will happen in terms of growth. But
yeah, well, Ireland and Germany both exporting their way possibly into success, but that can't happen across Europe, right?
Well, everybody can't. Well, I suppose you can. Everybody can export to everybody else, but it doesn't really get you very far. There is a concern that the exporting nations are probably a bit too reliant on one or two big buyers out there, and that's basically China. If you look at the export destinations, it's sort of flattened up everywhere, but to China it's just booming along. Now we've had some pretty downbeat news on China recently as well, so again for a sort of global growth pair.
Don't depress us anymore. We'll be watching that forecast of yours later on today.